The good news for investors today was that cooler than expected reading on inflation. The Fed holding interest rates unchanged, projecting just one rate cut this year. Our guest reminds us that despite the shift from 3 expected rate cuts to just one, the Fed's record for future monetary policy has been consistently unreliable. Well, at least they're consistent. We're joined by Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Art, thanks very much for coming on the show.
Well, thanks so much for having me. It's great to see you, Andrew.
So you think we shouldn't worry over much about the Fed's projections for rate cuts?
Yeah, and it's not just the Fed that's been pretty bad at projecting what rate cuts are going to look like or rate hikes are going to look like. The CME Fed funds futures have done a pretty poor job throughout the entire cycle. So when the Fed started hiking rates, they thought they'd get as high as 3 to 3.5%. They obviously missed the mark there, got significantly higher. They've pivoted now to being a bit more neutral. At the March meeting, there's 19 people that get to pencil in their end of the year Fed funds futures, Fed funds rate, and 10 of them had 3 or more, and 9 of them had 2 or less. So to get to 3, it was a very close margin. We thought that that might slip to 2, and it actually slipped to 1, but I don't think that makes much of a difference. I think what makes a difference here is that investors clearly have gotten to a place where they're willing to forego rate cuts for better economic data. Clearly, we're starting to see that, whether you look at last Friday's non-farm payroll number or if you look at today's CPI inflation report. I think the economy is going to drive earnings, and earnings in the first quarter were much better than expected. And the good news is estimates for the rest of the year have gone higher. So, you know, the Fed will likely cut rates this year. I suspect they do it in September. And I think focusing on the dot plots probably is a big waste of our time.
And you say this fairly low inflation rate this morning, the core CPI at its lowest of more than 2 years, is unambiguously positive for the markets.
It really is. And I think that when you extrapolate out of that, what that means for the core PCE, the personal consumption expenditure, which is what the Fed uses as their target inflation indicator, currently sits at 2.8%. So if we just took the data that we learned today from the CPI and furthermore take what we learned from the PPI this week, we'll likely see a core PCE going from 2.8% to 2.6%, which is exactly where the Fed had projected we'd exit this year, and we're gonna get there in the month of June. So I think the path of inflation has reaccelerated to the downside. I think that especially when you look at things like shelter costs. So for 2 months in a row, CPI's owner's equivalent rent has finally cracked. That hadn't happened in the last 10 months. So I think that's a positive. I also think that car insurance, a big component of the CPI at the headline level, has finally broken down. So some things that were much more sticky in the inflation numbers are actually starting to show some deceleration. I think that's a real positive sign. So I think the trend is your friend. We'd likely see inflation continuing to head south. And I think the Fed feels comfortable enough to cut rates at the September meeting. Oh, by the way, at that meeting, they'll have a fresh summary of economic projections, new dot plots, so they'll have more ways to disseminate the information about their decision.
So will America get anything like a recession, do you think?
Well, I would say it's going to be kind of hard in the near term when we're creating 250,000 jobs a month, which is 3-month average, when GDP forecasts for the second quarter are north of 3%. When the back half of last year we were running closer to 4% GDP growth. So we're running north of mean economic growth, and we're creating 250,000 jobs a month. That's not the typical picture that you would paint if you were expecting a recession. Now, that's not to say that something could come out of the blue and disrupt that, but it just isn't in the forecast right now. I suspect that we'll have above mean GDP growth this year, call it 2 to 2.5%. We'll have earnings growth that runs something similar to the first quarter, which is 8% for the S&P 500 throughout the balance of this year, and a lot of that earnings growth coming from those stocks that we don't talk about every day, the other 495 stocks that are part of that magnificent 5.
Do you get a bit bored sometimes with these 5 horsemen? We seem to just talk about them endlessly.
Yeah, I do and I don't. I think it's remarkable that you can have companies with market caps the magnitude that you have in Microsoft, Apple, and NVIDIA that continue to grow earnings and revenues at the pace that they're growing. Usually, you and I, having done this for a couple of weeks, are used to the laws of large numbers catching up with companies of this size. It just hasn't happened yet. And I think this is the new paradigm for those individual issues. I think some of the other names in that sort of Magnificent Seven that have fallen off certainly have their own structural reasons. But when you look at a company like Apple, it's growing their their software sales and the ecosystem sales that have margins that are north of 70%, and just now introducing what they're going to be doing with artificial intelligence is remarkable. It's a stock that really hasn't done anything for 2 years and all of a sudden broke out above 200 and has a lot of space above it. And NVIDIA continues to surprise us every time they report their earnings, and they instituted a buyback. And oh, by the way, they're selling everything they can make. So you've got a lot of reasons to believe that there's runway in front of this. And oh, by the way, the amazing thing to me is if you look at the multiples of just those three, they're all significantly south of 50 times. And in the case of Apple and NVIDIA, you know, I have a 40 handle and a 30 handle. And I think that that really speaks to the fact that this isn't irrational exuberance.
What's your thought on oil? Just to switch gears here, Art, would you be a buyer of oil stocks that are leveraged to the crude price right now?
I would. You know what's interesting? So the IEA put out a forecast, a 10-year forecast, saying that we're going to be oversupplied. And I think when you go back and if you were to Google it quickly or use artificial intelligence, you see the IEA has not done a very good job at forecasting oil supply and oil demand throughout the course of the last 50 years. So I'm not putting too much credence in that. What I do put credence in is the fact that we have very balanced supply and demand right now. A lot of it comes from North America. It's producing more than it ever has. A lot of it comes from OPEC, which has done a very good job at keeping quotas intact. But I think the demand picture, I think, picks up when you look at both India and China. India for sure, and China likely in the back half of this year. We're probably going to see a demand pull on all hydrocarbons and petrochemicals and oil in general coming from China as they resolve some of their issues and start to pick up economic growth. So I think oil, you know, between 75 and 85 is at a perfect place for North American E&P companies and the fully integrated majors to make a lot of money. And I think if you look at the unchallenging multiples and dividends that get thrown off of these companies, I think it's a great opportunity for energy companies right now. For sure.
Big dividends, stock buybacks, you name it. What about real estate, Art, in particular office real estate? Are we in for yet more pain there?
Yeah, we are. And, you know, unfortunately, this is the kind of pain that really plays out over an extended period of time. So we're starting to see some office buildings in major metropolitan areas come up against leases and then be resold in short sales. And that is going to be the nature of the beast with office space, because we just haven't gotten back to pre-pandemic occupancy rates. But we know that it's a slow-moving train because it happens over the course of 5 or 10 years, depending on the length of leases. So it's just now starting to rear its head. I think that will continue. I think that the banks that are levered against that have taken significant reserves against this. This is going to catch nobody by surprise that office is impaired. At the same time, commercial real estate away from office has actually done very well. Whether you look at multifamily, if you look at healthcare REITs, if you look at industrial, commercial real estate. So it's the office part that's impaired, and I think it's well reserved. I think it's going to be a slow-moving trade record. It's going to take us years, not months, to work that out.